Most people believe financial crises begin with panic, with breaking news and collapsing headlines. But history shows something very different. The biggest financial shifts begin quietly. No alarms, no chaos. Just small signals ignored by most and noticed only by a few. Right now, global financial markets. Stock indices are still standing, currencies continue to trade, and confidence appears stable. But beneath the surface, something is changing. This is not a video about fear. It is a video about awareness, because once markets move, they do. Not ask for permission for decades. Global growth was powered by cheap money, low interest rates, easy credit, and unlimited liquidity. But that era is ending. Central banks are no longer rescuers. They are now constrained players. And when liquidity tightens, every asset begins to reveal its true value. Have you noticed something unusual? Bad news no longer crashes markets immediately, and good news no longer creates strong rallies. That is not stability, that is uncertainty. Markets are waiting for clarity on interest rates, waiting for inflation signals, and waiting for geopolitical direction. Periods like this do not last long. They resolve either through renewed confidence or through sudden shock. Smart money does not chase headlines. It watches. Positioning right now, institutional investors are quiet and defensive. Cash levels are rising, hedging activity is increasing, and volatility protection is quietly being bought. These are not panic moves, they are preparation moves. This cycle is different. Governments are more indebted, consumers are more stretched, and trust in institutions is weaker. There's less room for error. In the past, central banks could print confidence, but today printing money risks destroying it, and that changes everything. This video is not about predicting a crash date. No serious investor does that. It is about recognizing pressure points where stress is building, which assets react first, and why gold, silver, and currencies often move before stocks, because markets whisper before they scream. In the next part, we will break down global debt, liquidity, and the trap central banks now face. Stay focused, because the most dangerous moment in financial markets is when everything looks normal. To understand where global markets are heading, we must first understand debt, because debt now controls almost every decision in the financial system. Governments, corporations, and consumers are all more leveraged than at any other time in history. Debt itself is not the problem. The problem is the cost of debt. When interest rates were near zero, borrowing felt painless. Governments spent freely, corporations expanded aggressively, and consumers relied on credit for daily living. But as rates rise, the system begins to feel pressure. Every percentage increase tightens cash flow, reduces flexibility, and increases risk. This is why liquidity matters more than headlines. Liquidity is the oxygen of markets. When liquidity is abundant, assets rise easily. When liquidity tightens, volatility increases and mistakes become costly. Central banks are now trapped between inflation and financial stability. If they cut rates too early, inflation can return. If they keep rates high for too long, debt stress can break something important. This is the central bank dilemma. They are reacting, not controlling. Bond markets are already signaling this. Stress yields are volatile, confidence is fragile, and long-term stability is being questioned. At the same time, governments face massive refinancing needs. Old, cheap debt must be replaced with expensive, new debt, which increases deficits and weakens trust. Investors see this and adjust quietly, reducing exposure, increasing protection, and preparing for instability. This does not mean collapse is guaranteed, but it does mean the margin for error is extremely small. One unexpected shock, one policy mistake, or one geopolitical event can rapidly change sentiment, because highly leveraged systems do not bend, they break suddenly. This is why periods of calm and debt-heavy environments are dangerous. They create false confidence while pressure continues to build beneath the surface. Understanding this dynamic is essential, because debt and liquidity drive every asset class. Stocks, bonds, currencies, and commodities all respond to these forces first, slowly, then all at once. As global pressure builds, the US dollar becomes the center of attention, because it sits at the heart of the financial system. When uncertainty rises, demand for dollars often increases, not because the system is healthy, but because the dollar remains the primary settlement currency for global debt and trade. This creates a paradox, where a strong dollar can actually signal stress rather than strength. A rising dollar tightens financial conditions worldwide, especially for emerging markets and debt-heavy economies. Inflation complicates this further, because purchasing power declines, even as nominal values rise. Central banks attempt to balance currency stability with domestic economic needs, but their tools are limited. Rate hikes support currencies but damage growth, while rate cuts support growth but weaken confidence. This creates volatility in foreign exchange markets, where sudden moves can happen without warning. Investors watch these shifts closely, because currencies react faster than equities. They reflect trust, or the loss of long before stock markets adjust. Historically, periods of currency instability precede broader market reevaluations because money itself is being questioned. This is why capital often rotates into assets perceived as neutral or scarce during currency stress. Gold, silver, and other real assets benefit not because they generate yield, but because they preserve value when trust in paper systems weakens. Inflation expectations also play a psychological role. Once people believe prices will continue rising, behavior changes, saving declines, speculation increases, and volatility accelerates. These forces interact quietly until a catalyst forces repricing. At that point, markets move rapidly and narratives change. Overnight understanding currency dynamics is critical because they connect debt, liquidity, inflation, and confidence into a single, powerful signal. When currencies lose stability, everything else must reprice around them. Hey everyone, and welcome back to the channel. Today, we're diving into a hot topic. The final phase of the economic cycle. What does it look like? And more importantly, how can you, as an investor, get ready for it? Let's break it down in a simple way. So, think of the economy like it's breathing. It expands and it contracts. The final phase, often called a late cycle or contraction phase, is when the economy starts to cool down after a period of strong growth. You might see inflation getting a bit high, interest rates climbing as central banks try to tap the brakes, and corporate profits starting to squeeze. It sounds a little gloomy, right? But don't worry. Every phase brings its own set of opportunities. We're talking about consumer staples like food and household products, healthcare, and utilities. These are often called all-weather stocks for a reason. They tend to hold up better when consumer spending tightens. Another area to look at is high-quality bonds. As the economy slows, central banks might eventually lower interest rates to stimulate growth, which can be good for bond prices. Also, don't forget the power of cash. Having some cash on the sidelines isn't about timing the market perfectly. It's about having the flexibility to jump on great opportunities when others are fearful.